Yeah, sure. If you can hear me, just confirm so I know that the rest of the attendees can hear me as well.
Yes, yes. Oh, I forgot to mention, hi everybody. You can mention and ask questions in the message box on the right hand corner bottom. You can type your message there, or you can type your message in, and you can even mail them to yashu@eneed.com. yashu@eneed.com. So Vic, you can take up the matter.
Okay, great. So everyone, welcome to the session about the income statements. What we're going to do is have a slight introduction about what the income statement is. This is part 1 of 3. The next 2 parts are going to be about the balance sheet and the cash flow statement. So these are the 3 most important accounting statements that will be extremely important when you actually go ahead to value companies or understand how each company is performing. And before we move on, as Yashu mentioned, if you have any questions, comments, queries, just feel free to type them bottom right where it says chat. Choose who you want your audience to be for the question. And I want to make this session as interactive as possible. So please feel free to stop me whenever you need. And don't hesitate to ask any type of questions that you have whenever you have them. So let's start with the PowerPoint presentation that you must have seen earlier that was shared with all of you. Okay, great. So what you see here is your first slide. What I want to equate this to is there are different ways in which a company can manage its incomes, its revenues, and its expenses. Before we delve into that, let's just think about ourselves, how we as individuals really manage our revenues, aka our salaries, and our own expenses, whether they have to do with, rent expense, mortgage expense, buying transportation, and so on. So the first idea is, let's say, if you're a salesperson, you probably get compensated with a particular level of salary, and the more sales you generate, you probably earn some commission. Which is exactly what I have here in front of you on the slide. So that is where your revenue comes in from. The expense component is, of course, you have to pay rent or mortgage for where you live. You probably own a car or at least pay for some sort of transportation expenses, whether it is to go to work or whether it is to travel to your potential clients. And, of course, then you have other personal expenses such as meals, that you may be taking at restaurants or other places, and other entertainment that you have. And last but definitely not the least, it's the taxes that you pay to the government, the federal government, the state government, and sometimes even the city government. Some of these expenses that you have, like for example the mortgage that you pay, have a component, essentially the interest component of that mortgage, which can be tax deductible. And what that really means is that, let's say, for example, if my salary is $100. Let me actually switch to this slide. This will make things clearer. Okay, great. Can everybody see this? See the Excel spreadsheet that I have up top?
Yes.
Okay, fantastic. So what I want to point out here is that, let's just say that I am earning $500 per year, making up numbers. That includes my salary as well as the commissions based on however many sales I've generated to my clients. Let's just say the $100 here is actually the amount that I have to pay to, whether it is to travel or any particular expense directly related to this salary or commission. Now that is what we equate to how companies also look at their revenue and their expenses. And what I typically mean by that is, let's say, if I am working for a company, let's just call it, if it's a pizza shop, they have particular revenues coming in. Let's say, over a particular year, they generate $400 in revenue. And the cost of goods sold means that the raw materials that were actually needed to make the pizza cost me $100, and that can be the vegetables, that can be the meat, the dough, the sauce, and so on, can be attributable directly to each pie of pizza that I sell. When you take out the attributable, the variable cost from your revenue, that gives you your gross profit, which in this case happens to be $300. Here, you can equate it directly to how, when we are generating $100 of expenses for traveling to a particular client, the $400 is the gross profit that you generate. Now, there are other expenses that we incur as well. As I mentioned earlier, you may be eating at restaurants, or you may be actually traveling to work, not directly for sale, but going to your office, or having other entertainment expenses. These are operating expenses, as I say here, which cannot be attributable directly to each particular sale. Similarly, for companies, there are expenses for the shop that cannot be attributable directly to a sale. For example, they probably have a shop where they're operating from, so they may have their mortgage expenses. They may even have employees that are selling pizza, that are selling other types of products that they make, and you cannot attribute those costs directly to each pie of pizza that is sold. So these costs are still incurred. They call it operating expenses. And when you take out the operating expenses total, combined with your cost of goods sold, those are your total costs directly to running the business. So in this case, it's $100 plus $60 plus $80. That gives you $240 of total expenses, including operating expenses. Let's take it a step further. Now, the building that I operate in, the building in which I actually run my pizza shop, may depreciate over time. Depreciation, what that means is it actually loses value over time. And when a particular asset is losing value over time, let's say, whether in this case we say it's losing $20 per year, that is a type of expense. Now, depreciation is not a cash expense. What that essentially means is when the value of the shop, the value of the building that I'm operating in is losing value, I'm not paying anybody $20. I'm not paying anybody $20. This is considered non-cash expense, but it is still a part of what you eventually consider to be net income, because that is how accrual accounting works. I'm not going to get too much in depth about that now, but I do want you to know that there's a difference between cash accounting and accrual accounting, and some of these are non-cash expenses. We will get into this a little more eventually when we discuss the cash flow statements and when we actually discuss the balance sheet. But know that depreciation is an expense that it does not directly generate an outflow of cash, as if, let's say a research or development or even general administrative of paying salaries to your employees. Going forward, we also have different types of expense, or companies have a type of expense called stock-based compensation. What that means is when you pay your employees, you may not be paying them directly a salary, a cash salary. Sometimes you may even want to pay your employee by giving them some stock in the business itself. So for example, let's say I'm the pizza shop owner and I have a total of 3 employees, 2 of which are the ones who I only pay salary to, and the third one, let's say he's a manager of the 2 employees, and I say in order to incentivize him to operate the pizza shop to the best of his ability, I pay him a portion of his salary in cash, but another portion is actually using stock. Stock meaning I give him a share of the business itself. So that incentivizes the manager to perform to the best of his ability, because now he has a stake in the business. He owns stock in the business. So that stock-based compensation is also an expense that is incurred by companies. Finally, so at this point, I just want to show you how the calculation or how I derived to operating income. So you can see what I initially took was the gross profit. If you remember, we went from the revenue that was generated by selling each pie of pizza minus how much we actually spent on raw materials, as in the dough, the sauce, the meat, the vegetables, and then we came to gross profit. From that gross profit, we even took out another $140 of expenses. Specifically, it was in research and development. You know, you're maybe researching which types of pies are most popular with certain types of clientele. And general and administrative include the salaries that you pay to your employees in cash. That's what led to the $140 of extra expenses. We spoke about depreciation, how the value of my building could be depreciating or decreasing as the longer I own it. Now, that is not a cash expense, but that can still be viewed as an expense, which we will get into later. Stock-based compensation is how we may be paying a portion of the salary to our manager in stock by giving him a pie of the business or a slice of the business, no pun intended. So that finally brings us to our operating income. Gross profit minus the total operating expenses minus depreciation minus stock-based compensation gives me my operating income. Now, let's say, you know, that yes, we are in the business of selling pizza, but on the side we also have a small, like a chocolate stand that, you know, people want to buy chocolate from, and that generates minimal income over time, but that can also be considered a part of our income. And for example, let's say in order to maintain that chocolate stand, we incur cost of $10, not the most profitable business, but it's just an incentive to bring other clients into the shop. Maybe they want to buy pizza, which actually makes us money, while they actually were attracted because of the fact that there's a chocolate store that we have inside. So finally, that brings us to our pre-tax income. And the way we came to our pre-tax income is by looking at the operating income of our core business, which was the pizza shop, minus whatever expenses and income we generated from our side business. In this case, it happens to be net zero. So our pre-tax income is the same as our operating income. Now, pre-tax income, as you can tell, you know, we took out some expenses that we paid in cash, you know, like the research and development and the general administrative. And then we also took out some expenses that we did not pay in cash, like depreciation. All these expenses, when they are taken out of the revenue, eventually bring us to pre-tax income. And now, of course, we have to pay Uncle Sam if you're a U.S. citizen, which means you have to pay the U.S. government, or whichever country that you're from, you have to pay taxes. In this case, we assume that, as you can see, the formula that I have up here, the tax rate is 40%. It's just a round number. In different countries, the tax rate can be different numbers, but now I'm just using 40% to illustrate this example. If we're paying $52 in taxes, our net income ends up being $78 on a revenue of $400. Now, let's say if my pizza shop had a total of 200 shares outstanding. Let's say I owned 150 shares, and as the owner owned 150 shares, and the manager was compensated with 50 shares over time. So in total, if the earnings per share is 39 cents, and the way, of course, I got that is by dividing the net income by the number of shares outstanding. So as I said, if I own 150 shares and the manager owns 50, I will be compensated 150 times 39 cents or 58.50 of the earnings, and the manager will be attributed $19.50 of the earnings. And if you add them together, $78, the same as the net income that we have. So as you can see, the income statement essentially gives you a snapshot of what the company has incurred over a particular time period. Let's say this was, for the calendar year 2012. In the calendar year 2012, there was $400 of revenue generated, which eventually led to $78 in net income. So this is what a typical income statement looks like. It gives you a picture of how the company operated and performed over that particular time. Okay, if there are any questions, please let me know. I do not see any coming in yet. but I will answer them as soon as they come in. So now back to the presentation that was shared with you earlier. We went over exactly how we as individuals manage our revenues and our expenses. We equated that or compared that to how companies actually manage their revenues and expenses. You know, you have the slides in front of you. You can go over them yourselves. But this is, you know, I gave you an actual example of what an income statement for a company and an income statement for a person looks like. We discussed how the revenues and expenses in an income statement are over a period of time. So, for example, the one I said that, let's just say, is for the calendar year 2012, which is the timeline of 1 year. But some companies also put out their financial statements for every quarter. And what that means is they will put out a balance sheet, a cash flow statement, and an income statement for that quarter. The income statement gives you a picture of how the company is operating from its very top line, which is revenue or sales, to its bottom line, which is net income. You will hear that jargon thrown around a lot, especially if you work on Wall Street or have spoken to people in the finance industry. When they say top line, it means revenue directly because the top line of the income statement is revenue, and when they say bottom line, they will mean income, net income, because literally the bottom line or the bottommost line of an income statement is net income. This necessarily does not have to be shown on the income statement. I just have it there for illustrative purposes. Okay? Here we have broken down how exactly which types of revenues companies can have. The example that I used with a pizza shop may or may not have all these different types of revenues, but this is some companies can have, the direct sale of goods, the commission received, the gain on sale of investments. If a company is in the business of actually selling property, they'll show you a gain as a revenue. Other incomes, which we discussed as having a side business within the pizza shop, which was in this case a chocolate stand, and income from services. A lot of software companies typically fall in this bracket because they don't provide you a direct physical product. Their product is actually a service, whether it is Adobe or whether it is Microsoft, who actually give you the Microsoft Office. We're using Microsoft Office's product, which is PowerPoint, which is a service. Expenses on the other side, we discussed how it was the purchase of goods. In our case, the specific pizza shop, it was the dough, the sauce, the vegetables, and the meat. Manufacturing is an expense if you actually have an assembly line through which your products have to pass to be turned from raw material to a final product. Administrative, we discussed, actually providing wages to your employees. Selling and distribution, the distribution channel of actually transporting the product that you've created to its eventual retail shop. Depreciation, we discussed how my pizza shop building is actually decreasing in value over time. Financial expenses, as in the interest that I pay on the money that I've borrowed to run my business, which we discussed here as being interest expense, right there. And the loss on the sale of investment, specifically if, let's say if I as a company also wanted to invest in the stocks, or let's say the S&P 500, if I had extra cash and I wanted to diversify my business, I wanted to invest in let's say the S&P 500, and I went out and bought some SPDRs, which is the ETF equivalent of the S&Ps. And if I held them, let's say, for a specific time period, in this case, let's just make things easier, I bought them on January 1st, 2012, and I sold them on December 31st, 2012, and let's assume that there was actually a loss on that investment, I would incur that loss on my income statement, because even though that is not a part of my core business, that is still a part of my side business. As we laid out here very clearly, that the income statement is always calculated or is always provided for a specified period. I have not written it up here, but typically the way is for the period ending December 31st, 2012. So that's when you would know that it is for the year. Just to make things even clearer, you would know that this is for the year 2012. Finally, this is, as I walk you through the actual numbers here, this is what the pro forma looks like, and this is how we at EduPristine want to ensure that our candidates understand, our students understand, that this is exactly how typically the CFA exam would be testing, and this is the format that they will be following. Sales minus cost of goods sold generates the gross profit, just like we have it here. The selling, administrative, and general, typically the shorthand of this is SG&A, which of course stands for selling, general, and administrative expenses, which brings you to operating income, or EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Amortization is the depreciation equivalent of intangible assets. There seems to be a question. Give me 1 second. This is the first question, so let me just make sure I'm doing this the right way. Okay. Okay, while I here, we'll continue here. As I was saying, A stands for amortization here, and the amortization is the depreciation equivalent of intangible assets. And so let's just say, for example, a depreciation is on a tangible asset such as the building in which I operate the pizza shop. Amortization is actually an intangible, the depreciation of an intangible asset, like let's say whether it is goodwill or a patent, which is losing value. You would amortize a patent over time just the way you would depreciate a real estate property over time. So once you take out depreciation and amortization, that brings you down to EBIT. EBIT stands for earnings before interest and taxes. After the EBIT, you take out the interest, which is actually the interest that you pay on the money that you have borrowed to run your business. If you recall, typically businesses, in order to operate, either have equity or financed by equity or debt. Equity is giving up ownership in your business, whereas debt is money that is borrowed, which eventually needs to be paid back from the person you have borrowed or the entity that you have borrowed from, along with interest. And this is exactly the interest that is paid on that debt sits on the income statement. Once you take out the debt, here's another item for you. As you can clearly guess, this stands for earnings before taxes. You take out the final line item before we get to net income. Income tax is, like I said, you have to pay your federal income tax, you have state income tax, city income tax, and so on. And that eventually brings you to net income. Okay, so it looks like there's a question here. Let me read it out to you. Income statements differ in generating income according to the method it has been prepared, variable absorption or throughput. May I know which one is more accurate according to the fact that some of our expenses are estimated, so what gives us an accurate figure? So as I mentioned earlier, if I can bring this up here, it's sometimes difficult to tell you exactly what the cost of goods sold is. It's because, let's say, for example, you have inventory. Let's go back to our pizza example. Let's say that I have bought a lot of dough and I had that sitting there for a few months, and I used some of that dough this month, and I'm going to use some of the dough next month. Let's say this month is December 1st and next month is January 1st. So whatever dough I use this month will be attributed to this year's income statement, and whatever dough I use in January of 2013 will be attributed to next year's income statement. But now, let's say, what if I bought the dough this year for, I don't know, $20, and what if I bought the dough that I'm going to be using next year for $25? And what if, let's say, I bought that together? it's very difficult sometimes to attribute saying exactly that the cost of goods sold this year was 20, whereas next year it will be 25. So that's when you use your best case assumption, saying, okay, I know that the dough that I have brought in this year will be the one that I use this year, and the dough that I will bring next year will be the one that I use next year. So in this case, that's a system that we use that is known as Lifo and Fifo. This is a new concept that I want to enlighten you about. Okay, so let's say that this year we bought product for $20, and next year we bought product for $25. LIFO stands for last in, first out. FIFO stands for first in, first out. Probably clearer for you. So what that means is, let's say in year 2, if I bought the product for $25 and I'm using the LIFO, last in, first out method, then the expense method that I'll use for this year will be the $25 allocation, because I'm saying whatever I brought in later is going to be utilized first. On the other hand, if I'm using the FIFO method, which is the first in, first out method, meaning that whatever I brought in first gets out first, then the expense for this year will be $20. Now there's also a third way of actually utilizing or allocating cost when you have bought raw materials at more instances than one at different prices, and that is the average cost method. And what that does is say, okay, if I bought equal units, let's just say I bought 10 units here and 10 units here, the way I would come up with the average cost is to say it is 10 divided by this plus this, which is the total. So let me make things easier for you guys. This is the total. So the way you would do this is say it would be 10 divided by this number, which is the total number, times how much you paid for it, plus this number divided by the total number times how much you paid for it, 2250. So 2250 is how much you would allocate for each year. So I hope that answers your question. I cannot tell who the question is from. It's from Mr. Nassar. And I hope that answers your question. If that does not, please let me know. So these are the different ways in which cost can be allocated, and to a certain extent it is utilizing your best guess as to how you would like to allocate that cost, whether you want LIFO, FIFO, or average cost. Okay, are there any other questions? Okay, so it doesn't look like there are any other questions. So just stay tuned for our future invites. Of course, this was the income statement. I hope this gave you a broad understanding of how companies look at their statements, specifically the income statement, and how it goes from the top line, which is revenue, through all these costs, and eventually leading you to net income, which is the bottom line. So stay tuned. Our next sessions will be on balance sheet and cash flow statements, which are the two very important statements in addition to the income statement that we discussed today. Thank you.
Hey Vic, thank you. That was a great webinar. I'm sure that has cleared a lot of doubts. I think there was one of them regarding the method it has been prepared with, variable absorption and throughput. So can you please elaborate on those, please?
Variable absorption or throughput?
Yes, I think Ahab had a doubt regarding the same.
So it's, I believe, can that question be clarified? I'm not too sure what the person means by variable absorption or throughput. What I believe they meant was how is cost being allocated based on the variable consumption of raw materials. If that is different, if that is different from the way I understand it, please let me know.
Ahab, is your doubt clarified? Okay, so that...
Albina has raised her hand, or I'm not sure if she's still available, but there has been Albina who has been raising her hand for quite some time. I just noticed that. I clicked on it. I'm not sure if Albina received that notification. Albina, if you have a question, please feel free to share it with me, the audience, or our host.
I think that was just when we were checking about the mics and all. So I think that she's...
Okay.
Yeah. So that brings us to the end of the session. And it was great having you, Vic. I'm sure income statements have been clarified to quite a great extent. And
I certainly hope so. And like I said, hang in, the rest of the attendees, please hang in there for our upcoming notifications about the balance sheet as well as the cash flow statement.
Yes, the date will be out soon, and we can all subscribe to the webinar. Thank you. Thank you everyone for attending.
Thank you.